Welcome to Practical Assets. Options are one of the most misunderstood investing tools, but once you understand the basics, they're actually built around a very simple idea. In this video, I'll explain call options using a house example before showing you how they work in the stock market. By the end of this video, you'll understand what a call option is, strike prices, premiums, expiration dates, option contracts, in the money, at the money, and out of the money, intrinsic value and time value, what exercising an option means, why many investors simply sell their option instead, and why options can create larger percentage gains, but also much larger risks. Don't worry if some of those terms sound unfamiliar right now. By the end of this video, they'll all make sense. If you'd like to go much deeper into options trading after this video, I've written a book called Profitable Stock Options Trading: Lessons I Learned. Losing $100,000 to accelerate your trading success. I'll tell you more about it near the end of the video. This video is for general educational purposes only and should not be considered financial advice. Options are higher risk investments and may not be suitable for everyone. Always do your own research before investing. If you find this video useful, please click the subscribe button. It costs you nothing, but it really helps the channel grow. Stock options can be confusing, but a simple house example makes them easier to understand. Once we've covered this, we'll apply the same principles to the stock market. Let's imagine you found your dream house. It's selling for $600,000. You'd love to buy it, but you won't have the money for another 3 months. So instead of losing the opportunity, you make the owner an offer. You say, "I'll pay you a $10,000 premium today for the right to buy your house for $600,000 any time during the next 3 months." The owner agrees and you both sign the contract. That contract is legally binding. The owner is now legally required to sell you the house for $600,000 if you choose to exercise your right before the contract expires. But notice something important. You are not legally required to buy the house. You have the right, but not the obligation to buy it. That's exactly how a call option works. Let's look at what happens next. 3 months later, the housing market has taken off. Your house is now worth $700,000, but because of your agreement, you can still buy it for $600,000. That was a fantastic deal. Now imagine the opposite. The housing market falls. 3 months later, the house is worth only $550,000. Would you still buy it for $600,000? Probably not. Instead, you simply let your option expire and either walk away or buy the same house on the open market for $550,000. The most you can lose is the original $10,000 premium you paid. That's one of the biggest advantages of buying call options. Your potential profit can be substantial, but your maximum loss is limited to the premium you paid. Now let's replace the house with shares in a company. The idea is exactly the same. Instead of buying a house, you're buying the right to purchase shares. Let's match the two examples together. The house becomes shares in a company. The agreed purchase price becomes the strike price. The $10,000 premium becomes the option premium, and the 3-month agreement becomes the option's expiration date. These 4 terms form the foundation of almost every call option you'll ever buy. Now that we understand the basic idea behind a call option, let's look at how they're traded. Unlike shares, options are normally bought and sold in contracts. In the United States, one option contract normally controls 100 shares of the underlying company. This often surprises new investors. When you look at an options chain, you might see an option quoted at $2.50. Many beginners think the option only costs $2.50. It doesn't. That premium is quoted per share. Since one contract normally controls 100 shares, you multiply the premium by 100. So a premium of $2.50 multiplied by 100 shares means the option actually costs $250 plus any brokerage fees. Understanding this is important because it tells you exactly how much capital you're risking before placing a trade. One important thing to understand is that the premium isn't fixed. Just like the price of a company's shares changes throughout the trading day, the premium of an option also changes constantly while the market is open. If more investors want to buy the option, its premium may increase. If demand falls or time passes without the shares moving as expected, the premium may decrease. That's why you might buy an option for $2.50 today, and tomorrow it could be worth $3.20 or $1.80, depending on what has happened in the market. Unlike the strike price, which is fixed when the option is created, the premium moves up and down throughout the trading day, just like a share price. This means you don't have to wait until the option expires to make a profit. If the premium increases, you may be able to sell your option contract for more than you originally paid. We'll explain that process in more detail shortly. One of the first things you'll hear when people talk about options is whether they're in the money, at the money, or out of the money. Let's keep using a simple example. Imagine a company's shares are currently trading for $50 in the money. If your call option allows you to buy those shares for $45, your option already has value. Why? Because everyone else has to pay $50, but you have the right to buy for $45. That option is called in the money. At the money now, imagine your strike price is $50, exactly the same as today's share price. You can buy for today's market value, but you don't have an immediate advantage. This option is called at the money, out of the money. Now imagine your strike price is $55 while the shares are still trading for $50. Why would anyone buy shares for $55 when they can buy them on the stock market for $50? They wouldn't. This option is called out of the money. At this point, it has no intrinsic value, but as we'll see next, it may still have value because there's still time remaining before it expires. What is intrinsic value? Let's go back to our in the money example. The shares are trading for $50. Your option gives you the right to buy them for $45. Ask yourself one simple question. If everyone else has to pay $50, but your option lets you buy them for only $45, how much is that right worth? The answer is $5 per share. That difference between today's market price and your strike price is called the option's intrinsic value. It's the value your option already has today. Since one contract normally controls 100 shares, that means your option contains $5 multiplied by 100 or $500 of intrinsic value. Even if the option expired today, that value already exists because you can still buy below the current market price. You might now be wondering, if my option already contains $5 of intrinsic value, why might it actually be trading for $7? That's because every option premium is made up of two parts. The first is intrinsic value. That's the value the option already has today. The second is time value. Time value is what investors are willing to pay because there's still time for the share price to move even higher before the option expires. In our example, the option premium is $7. Of that, $5 is intrinsic value. $2 is time value. Every option has an expiration date. Think of it like the expiry date on a voucher. Once that date passes, the option no longer exists. When you buy a call option, you're buying time as well as the right to buy the shares. Many US stock options have monthly expirations on the third Friday of the month, while many popular shares also have weekly options that expire every Friday. That's why it's so important to check the expiration date before buying an option. The amount of time remaining can have a significant impact on the option's price. As the expiration date gets closer, the option gradually loses its time value. By expiration day, all of the time value has disappeared. This is called time decay. Only the intrinsic value remains. If the option finishes in the money, it still has intrinsic value. If it finishes out of the money, it may expire worthless. This is why choosing the right expiration date is almost as important as choosing the right strike price. Let's assume your option has become valuable. The shares are now trading for $50. Your strike price is $45. You now have two choices. The first is to exercise the option. Exercising simply means using your contractual right to buy the shares at the strike price. In our example, you would buy 100 shares at $45 each. That means you'd pay $4,500 for shares that are currently worth $5,000. You now own the shares and immediately have $500 of intrinsic value. Your second choice is simply to sell your option contract. This works much like selling shares that you already own. You are not creating a new option. You are simply selling the option contract that you previously bought. Many beginners believe they must exercise every profitable option. In reality, many investors simply sell their option contract before it expires. Let's go back to our earlier example. The shares are trading for $50. Your strike price is $45. The option has $5 of intrinsic value. But let's say the option is actually trading for $7 per share. That means the option contract is worth $7 times $100 or $700. Remember that $700 is made up of two parts. $500 of intrinsic value, $200 of time value. If you exercise the option, you receive the benefit of buying the shares below the current market price. However, by exercising, you effectively give up the remaining time value. If instead you sell the option contract, you receive the option's full market value, including both its intrinsic value and its remaining time value. That's one reason many investors choose to sell their option contract rather than exercise it. So why do many investors choose options instead of simply buying shares? The answer is leverage. Let's compare the two. Imagine a company is trading for $50 per share. If you buy 100 shares, you'll invest $5,000. Now imagine the share price rises by just $1. Your shares are now worth $5,100. You've made $100. That's a 2% return on your investment. Now let's compare that with a call option. Instead of investing $5,000, you purchase one option contract for a premium of $300. The stock makes the exact same $1 move. The option might increase in value from $3 per share to around $4 per share. Your option contract has increased in value from $300 to $400. You've still made $100, but this time you only invested $300. That's a return of approximately 33% compared with just 2% from buying the shares directly. This is called leverage. Leverage is one of the biggest attractions of options, but it's also one of their biggest risks. Like any investment, call options come with risks. The biggest advantage of options is leverage, but leverage works both ways. Just as a small rise in the share price can produce a much larger percentage gain, a small fall in the share price can produce a much larger percentage loss. Unlike owning shares, options also have a limited life. every day that passes brings the option one day closer to expiration. As that happens, the option gradually loses its time value. If the shares don't move in the direction you expected before the option expires, your option could lose some or even all of its value. And if it expires out of the money, the option may expire worthless. That means you lose the premium you originally paid. This is why successful options traders don't just focus on picking the right company. They also consider the strike price, the expiration date, and how much they're willing to risk before entering the trade. So why do investors buy call options? There are several reasons. Some investors believe a company's share price is about to rise and use call options to potentially benefit from that move. Others use call options because they allow them to control a larger investment with less capital than buying the shares outright. Some investors also use call options as part of broader investment strategies to help manage their portfolios. We'll cover many of those strategies in future videos. The important thing to remember is this: a call option is simply another investing tool. Like any tool, it can be extremely useful when you understand how it works, and very expensive when you don't. If today's video has helped you understand call options and you'd like to learn much more, I've written a book called Profitable Stock Options Trading: Lessons I Learned, Losing $100,000 to Accelerate Your Trading Success. The book goes well beyond today's introduction. It covers real trading experiences, common beginner mistakes, trading psychology, risk management, and practical options strategies that I've developed over many years of investing. If you're serious about learning stock options, the book is available on Amazon, and you'll find a link to the book in the description below. Today, we've covered a lot of ground. You now understand what a call option is, how the house example relates to the stock market, strike prices, premiums, expiration dates, option contracts, in the money, at the money, and out of the money, intrinsic value, time value, exercising an option, why many investors sell their option contract instead, and how leverage can magnify both gains and losses. If you found this video useful, please subscribe to Practical Assets. It costs you nothing, but it really helps the channel grow. Thanks for watching, and I'll see you in the next video.